if something happens geopolitically or we have some kind of attack in the U.S., that could change things as well. So a lot of things that could change it, but the economy is slowing. GDP is generally slowing. That's what you want to happen. And if we're going to have a recession, that's what has to happen.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to Watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, consumer confidence is dropping. Housing sales are dropping. A lot of other things are dropping. Anthony Saccarro is with us now. Anthony, what is with this economy? We heading straight to recession?
Yeah, Kerry, thank you for having me. A pleasure to join you as always. The consumer confidence did go down. Not really a surprise. I don't think we're headed straight towards a recession. If you would have talked to me 6 or 8 months ago, maybe even closer to a year at this point, we would have said that a recession was inevitable, and that a hard landing was something that was almost a definite. I think that was pretty much across the board. And now what you're starting to hear is more of the soft landing approach, where people are tending to think that there could be a soft landing, but I believe that could be the case. I also think that the market will do the opposite of what most people think. And we've seen that happen over time. And so we could still have a recession. It could be severe. Consumer confidence, they're not confident. That's what the reports have told us for a lot of reasons. Inflation is still elevated, even though it's come down quite a bit. But now the geopolitical fears, right, with the two wars and not one, essentially we've doubled our geopolitical worries over the last 2 or 3 months, and that's certainly not helping things either. So we're not out of the woods by any means. I think investors just have to be really cautious and really careful.
Okay, so we had this GDP report. What's your take on the latest GDP numbers, Anthony?
Yeah, so GDP is continuing to come down. The Federal Reserve is indicating that because of that, they're probably going to hold. They're still talking strong, at this point, and I think they should be. But all the odds are at this point that they're going to be holding rates. They're probably not going to raise rates anymore. I still think that there could be a 25 basis point increase. But I think the likelihood is low. If I'm gonna put my money there, I'm gonna say no. They're probably not gonna raise rates. It's still possible. I don't necessarily think it's probable, and I think the futures market right now is pricing in like a 95% chance that they don't touch rates. But there are things that could change that. If we get an out of whack inflation number, that certainly could affect things. If something happens geopolitically or we have some kind of attack in the U.S., that could change things as well. So a lot of things that could change it, but the economy is slowing. GDP is generally slowing. That's what you want to happen. And if we're going to have a recession, that's what has to happen.
Mm-hmm. All right. So recession's good or bad here?
Yeah, that's a great question. Interestingly enough, all the media and all the marketing people out there, all the talking heads, they want you to believe that it's bad. It's the big R word. The reality is the economy is going to go through booms and busts. Your life is going to go through booms and busts. There are cycles. Life is full of cycles. The economy is full of cycles. The stock market is full of cycles. And when you try to fight those cycles, when you try to keep it always elevated all the time, that's not good, because then when a crash happens or when a recession happens, it actually makes it worse. The answer to your question, quite frankly, is a recession is good. Without a recession, we're not going to lower inflation. We want prices to come down. The Federal Reserve wants GDP to come down. They want inflation to come down. But what a lot of people don't understand is if inflation comes down and spending comes down and corporate revenues come down or profits come down, that's good for inflation, but it could cause a recession. But there's also a balancing act. The Federal Reserve wants slower growth, but they don't want to slow growth so fast that it then causes a recession. But a recession is not bad. It's healthy, actually. It wouldn't be bad for where we are right now. And ultimately, I think that is what they want, but they're never going to tell you that.
All right. So they're caught between a rock and a hard place, aren't they?
That's the factor, is they really are caught between a rock and a hard place. And a recession, too, is a mental game. when we enter a recession, consumers tend to think, well, I'm not going to spend more money. It's that negative wealth effect. People tend to spend money when they're feeling good about things. They tend to not spend money when they're not feeling good about things. So the fact is that when they talk about a recession, or when we have 2 quarters of negative GDP growth, which is the legal definition of recession, or they come out and basically say we're in a recession, well, consumers' mentalities change. And all of a sudden, people start spending less because, oh my gosh, we're in a recession. And it becomes a self-fulfilling prophecy, and it becomes a snowball that could turn into an avalanche, not because the fundamentals have changed, not because things are so falling apart that it requires everyone to go out and sell all their stocks, and not because of any of that, but because mentally people are just not feeling good. And then you throw on the fact that we have higher yields now that actually compete with the stock market. People have a place to go as an alternative, and that certainly doesn't help a recession to end.
All right. The old joke, difference between a recession and a depression, right?
You did.
Recession's when you're out of work, depression's when I'm out of work.
That's right.
So it all depends where you're standing, right?
That's exactly right. You're 100% correct. And it is all a matter of perspective for sure.
Right. So, all right. So let's bring this down to the micro level. You're an investor. You're thinking of retiring in the next 3 to 5 years. What are you supposed to do here?
Yeah, it's a great question. I'm going to suggest that you have to be very, very careful. And past performance does not predict future results. We've heard that, right? What happens is there's this, psychologists call a couple of mental phenomenons by certain names. There's recency bias, and then there's normality bias. Mm-hmm. Recency bias says that we tend to believe what's happened most recent. We tend to think that that's what's most fresh in our mind, and we tend to live by that. Normality bias is we tend to think that everything is going to continue to remain the way that it's been. Well, the challenge is for the last almost 15 years now, the stock market's gone straight up. If you go back to the bottom of the market in 2009, at the bottom of the financial crisis, and you charted that, March 9th of 2009 to now, it's about a 15% annual return for the last 14 years. Now, if you go back the previous 14 years, it's no growth. So it's the tale of 2 decades, no growth for 14 years roughly, and then now 15% plus growth for another 14 years. And the recency bias says that this is what people are thinking of. They forget that we had a 2008. They forget that we had a 2001. They almost think that the stock market is now a safe investment. And if you're about to retire in 2 or 3 years and we have another 50% or 60% crash, we can't say that that's not going to happen. We've had 2 of those in the last 23 years. To say that it can't happen again is just being illogical. But if we have another, crash like that, and you're going to retire about that time that your portfolio is down by 40 or 50 or 60%, it's going to affect your retirement. And people think that can't happen again. They're very optimistic about things as far as the stock market. And I'm seeing that a lot of people are going into retirement fully invested in equities and really just kind of keeping their fingers crossed, hoping that they can retire. They might not know they're doing this, and that's what scares me the most. Is the recency bias says that, you don't have to worry about it. You'll be fine if you're going to retire in 2 or 3 years. That's not the case. If you're within 10 years of retirement, you need to start shoring up now to make sure that you can retire, not only if the market does good, not only if the economic indicators are in your favor, but I want you to be able to retire anyway, regardless of what happens. And, a lot of people are not in that position. Their retirements are dangerous.
Okay. So you got to be very careful at this particular point in time, don't you?
Yeah, 100%. And, I've done several recent interviews recently, and I've talked about, putting yourself in a position to win no matter what. And, when I say that, we get a lot of questions. A lot of people ask, well, what do you mean win no matter what? You're only going to win if the market does well, right? Well, no, if you're invested in the market, you're only going to win if the market does well. But if you're retired, the fact is there's a whole universe of options that are designed to give you interest and dividends. And as a matter of fact, most investments that are growth oriented, where, when you talk about growth, Kerry, it's all about share price, right? Buy low and sell high. And that's what you want to do. And, that always doesn't work out because you might make a lot of money, but you can lose a lot of money so the reality is most growth investments can be engineered for income. Stocks are a good example. You can buy growth stocks with no dividends, or you can buy value stocks with a 3 or 4 or 5% dividend yield and focus on income. And right now, it's the income, I think, for the next decade you can count on. Earlier, we talked about, the first 13 years of this century was flat. The last 13 years is 15% plus. If history repeats itself, we could have another flat decade. And a lot of economists are thinking that this could happen. So how do we benefit from that? And the answer is in yield. The answer is in dividends. Focus on income. If you have a high quality income producing portfolio, you can count on your dividend and reinvest those dividends. So if we do have crashes and recoveries, as is always the case, then at least you've got dividends to dollar cost average back in, and you won't come out flat. You'll come out smelling like a rose.
All right. Well, we like that. And that goes along with your book, right?
Yeah, absolutely. I talk a lot about investing for income in my new book, More Life Than Money, which is become an Amazon #1 bestseller, which I'm proud of in a lot of different categories. But the book, More Life Than Money, takes my almost 25 years of experience in helping people retire. And I come up with 10 topics, 10 mistakes that I've often seen retirees make that can wreck your retirement. It's not what you know that will hurt you. It's what you don't know that will hurt you. And there are 10 things that most investors, most retirees don't know about retirement that could wreck their retirement. That's what the whole book, More Life Than Money, is about, just to help retirees learn what they need, get educated about what they need, so you increase the odds of having a successful retirement.
And that's what we all want and need. Hey, where do we find you, Anthony, and where do we find the book?
Yeah, thank you so much. To find the book, you can go to morelifethanmoneybook.com, or you can search for More Life Than Money on Amazon.com. My website is providencefinancialinc.com, providencefinancialinc.com. And, if any one of your listeners have a question for me, they want to talk about this, they're about to retire, look, I'm more than happy. I'm an educator. I'd love to help them in any way. So they can always look us up on the website, fill out our contact form, and, I'm certainly have a quick call with them if there's anything I can do to help.
All right. Excellent. Hey, appreciate you coming on, Anthony. I've got a question for Anthony. Myself, KL@kerrylutz.com is the email address to send it to. And you'll find the links to Anthony's book and his site on the show notes to this interview on financialsurvivalnetwork.com, and sign up for your free newsletter while you're at it. Anthony, always a pleasure. Thanks for coming by.
Thank you for having me. Great seeing you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.